So, once again, welcome back to the session of financial management. And as we are discussing the unit 2, in the unit 2, we have different content, different topic that we need to understand. Out of all the topics and content, first we have tried to understand various sources of finance. In our sources of finance, we have understand four different sources. Okay, the first source, that is about equity share capital. Okay, second, preference share capital. Third one, debt capital, specifically debentures and long term loans. And fourth one is about depreciation fund that we have created, that company have created. And internal reserves like retained earnings, capital reserve, general reserve. These are the internal. Now question comes to us, which source is more suitable for our company? If we have company, if we are managing the company, or if we are the finance manager of the company. Now second question comes to us before going for the final decision about the source of finance, that whether we go for the equity share, whether we go for the preference shares, okay, or whether we go for a debt capital. That depend again on some parameters. So for that we have a second topic. So second topic is cost of capital. At which cost we can acquire equity, we can acquire preference, we can go for a debt capital, specifically debentures and bank loans. So please open your book and write down the title. And title is cost of capital. Again, I repeat, this entire chapter is divided into four parts, different four parts, okay, for better understanding purpose. The first part is sources of finance, theoretical part. Second part is a cost of capital. Again, this one is a purely practical aspect of this unit. So please be ready. And write down the title, cost of capital. Just 1 minute, I am sharing the screen, and then after we go for the further discussion. One minute, huh? It's opening. Title done, cost of capital. Everyone. Say yes or no. Okay, good. Now, is it visible? Okay. So before going for the further discussion about the cost of capital, just understand what we mean by capital. So capital means money required to start a business, to operate a business. And cost means, cost means, suppose I am manufacturing a laptops. Okay, so for manufacturing a laptops, we require some parts, some circuits are required, some plastics are required. Okay, processor is required, other systems are required, battery is required, the display is required. Okay, glasses are required. So if I combine the cost of batteries, processors, a plastic, a glass, screen, then other things that are required, then whatever the sum total comes, that is called as a cost. Okay, suppose I'm manufacturing the clothes. So manufacturing the clothes, whatever the expenses are there, cost of cotton, cost of other material, cost of colors, cost of labor, cost of processing, cost of packing, cost of designing. This is called as a cost of that particular product. So in short, for acquiring any product or a service, the sum total of expenses are known as a cost. These two words are clear. Cost means a total expenditures to get something. It may a service, it may a product. Capital means a money required to start a business or operate a business. When we discuss the capital, here capital means a business capital, and here business capital is divided in three different categories. Let me share that. Just 1 minute. Why it's not moving? It is visible first of all. Okay, yes. So when I discuss the cost of capital means we need to here understand how we can determine, how we can calculate the cost of equity capital, cost of preference capital, cost of debt capital, and cost of retainer. We have a four different sources, so we need to understand the cost of each and every source of finance, every source of capital. So just quick review about the meaning and definition of cost of capital. Okay, as we have discussed that the cost of capital is a part of investment. Sorry, it's a part of a financing decision, and it is used to calculate the proposal or a cost of proposal for the business concern. Okay, and the firms are using a different sources of finance. The finance manager must take a careful decision regarding the cost of capital, because if the cost of capital is high, it may happen that it will adversely affect the profitability and value of the business. So here cost of capital is important decision in a financial management. Next, cost of capital is also known as. Please remember these words, these titles. Okay, very important for MCQ question, 1 mark question for mid one, mid two, and even though for a final. Cost of capital is known as a cutoff rate, target rate, hurdle rate, and required rate of return. Required rate of return. Let me explain one by one. Here, cutoff means a specific rate is there. Suppose for a passing criteria, you need to secure 40%. So this 14% is considered as a cutoff rate. If your percentage are below the 40%, you are passed. If your percentage are, sorry, if your percentage are above the 40%, you are passed. If your percentage are below the 40%, you are failed. Are we clear about the cutoff rate? It's a standard rate. It's a particular rate that decide whether it is positive or whether it is negative, whether it is pass or whether it is fail. Next one is target rate. Okay. Suppose India England match is there and India has betting and India has created suppose 250 rates. So now this 250 rates is a target for a England team. Similarly, in a financial management, we have some target, okay, that we want a 10% interest on these securities, we want 5% interest on these securities, we want 10% dividend on this shares. So these rates are called as target. It means this rates are fixed by the company by putting a particular target. Next one is hurdle rate. It's similar to a cutoff rate. Its hurdle means if you are facing some hurdles, okay, we are saying that this, yes, opticals. So it's a particular opticals. If you cross it, if you cross the hurdles, it's a benefit to you. Okay. If you are failed, then it's again a loss to you. Right now the Olympics, okay, is running going on. Okay, so if you want a gold medal, you need to cross the obstacles. Okay, you need to cross that particular limit that created by the your competitor. That your competitor is hurdle for you. So if you crack it, if you clear it, if you beyond that, you are the finalist. You are the gold medalist. You are the silver medalist. Are we clear about it? Okay, and last one, required rate of return. It's a very simple. Okay, whatever the demand, okay, the predetermined rate that is fixed by the firm, that we want this much of return from this investment. So cost of capital is may known as cutoff rate, hurdle rate, target rate, and required rate of return. Four names are there. Maybe the question asks that cost of capital is known as option A, cutoff rate, option B, target rate, option C, hurdle rate, option D, all above. Then your answer must be D. Okay. Now the meaning of the cost of capital. Cost of capital is a rate of return that a firm must earn on a project investment to maintain its market value and attract the fund. In a simple language, in a simple words, cost of capital means a minimum rate of return that firm or a company must be on from that investment. If I have invested 20 lakh rupees in X project, that project give me a minimum return of 20%. So this 20% is considered as cost of capital. If I invested 50 lakh rupees in project Z, okay, then that will give you me a 25% return, then 25% is considered as a cost of capital. So are we clear? The basic background is clear? Okay, now please remember the second definition. Okay, according to Solomon, cost of capital is minimum required rate of earning or a cutoff rate of a capital expenditure. Here, capital expenditure means long-term expenditure, long-term investment. So for long-term investment, whatever the minimum requirement or minimum required rate is there, that rate is called as cost of capital. So in short, cost of capital means minimum return rate or rate of return. If you want to write down, please write down in a book. Cost of capital means minimum required rate or a return. Shall we go for the next? Okay, suppose let's take one more example. Then after we go for the practical aspect. Okay, suppose right now you have 5 lakh rupees. Okay, you have 5 lakh rupees, and you are going to invest somewhere. Now, bank X will provide you a 10% interest rate. Bank X will provide you a 10% interest rate. Bank Y promise you to give you a 50% interest rate. Okay. and the Jet Bank give you a 8% interest rate. Which bank you will prefer for your investment? Now here, the investment means this bank will give you the return. Jet will give you 8%. Okay, X will give you 10%. Y will give you 15%. So which bank you will prefer for your investment if you have 5 lakh rupees right now? I'm damn sure that 100% people are saying Y. Okay, I am agree with you. I also go with the Y because I will get a more return. Okay, now change the place. Now change the place. Now you are the bank Y and I am your customer. I am your card. Are you getting my point? So from the point of view of bank, from the point of view of bank, your loan, okay, or loan provided to you is earning a more return. Are you getting my point? अब आप देखो कि आप बैंक वाई हो. For you, it is expense. You need, it is income. It is income. You will get a 15%. If you invested 100 rupees, you will get 15 rupees as an interest. But now think from the point of view of bank. Now from the point of view of bank, now this 15 rupees is an expense for a bank. If you deposit 100 rupees, okay, bank will give you 115 rupees, 115, because 15% interest will be added. So, are you getting my point? Are you getting my point? So, when we invest somewhere some amount, at that time, whatever the return will be generated, that is income for us. But from the point of view of banks, from the point of view of financial institute, from the point of view of companies, it is expense. And that's why we have added the cost of capital, cost of preference, cost of debt, and cost of retained earning. If the company issue the equity share capital, equity shares in the market, the investors have invest their money in the equity shares, they will get the dividend. So for the investors, it is an income, but for a company it is an expense. So that's why whenever we use some money, specifically money of other parties, it may equity shareholders, it may preference shareholders, it may debentures, or it may internal source. Okay, so at that time, first of all, we need to look at to that particular cost of the capital. Now suppose इसी एग्जाम्पल को मैं रिवर्स कर देता हूं. इसी एग्जाम्पल को मैं रिवर्स कर देता हूं. Instead of you have a surplus of 5 lakh rupees, you are required of 5 lakh rupees, and you are approaching the various banks. You have approached the three banks, X, Y, and Z, and three of are saying the same rate. Okay, X said we charge 10% interest, Y said we charge 15% interest, and Z said that we charge 8% interest. Now, can you tell me which bank you will prefer to get a loan? Yes. Okay, so always we prefer a lowest cost bank. Okay, lowest cost bank means a bank having a lowest interest rate. So in this case, the Z having the lowest interest rate, so we will prefer to take a loan from the Z. So concept is clear. When we required money at a time, we first look at to the cost of that money. कि वो money हमें कितने में पड़ेगा. But when we go for the investment, first we look at to the return. This is our nature of human being. So please open your book and write down the main title. Already have written the title. Okay, cost of capital. Under that, now the determination or computation of cost of capital. हमारे पास जितनी भी कैपिटल से उसकी कॉस्ट हम कैसे कैलकुलेट करें? सो फर्स्ट वन, कॉस्ट ऑफ इक्विटी कैपिटल. Please be ready with your pen and books. If you are not if you are not writing, please start writing. Okay, note down all the things that we require to write. Because in the practical questions, we have only short forms. Okay, and we have only the numbers. We don't have this theoretical points. So first of all, you need to understand the concept. You need to understand the short forms. Okay, meaning of short forms. So here, cost of capital, specifically cost of equity capital. So write down the number one, the first type of cost of capital, cost of equity capital. Generally, it's known as KE. K stand for cost. K stand for cost, and E stand for equity capital. Are we clear about the short form? Good. So now try to understand the meaning. A minimum rate of return that a firm must earn on an equity finance proportion of an investment project in order to leave unchanged the market price of the share. If you divide this entire definition in two or three parts, you will get the clear idea. Number one, minimum rate of return. Minimum rate of return. This is the first part, minimum rate of return. Minimum rate of return. Number two, must earn on equity finance. On which finance? Equity finance, so that lived unchanged market price. Three components are there. Minimum rate of return, firm must earn on equity, and it will live unchanged. Unchanged means the market price of equity shares are remain unchanged. There is no change in the price of the equity shares. So in simple language, if I explain it, so cost of capital means a minimum return on equity shares which help a company to maintain the same share price in the market. Are we clear? The concept is clear? वापस से एक बार मैं बोल देता हूं, कॉस्ट ऑफ कैपिटल मतलब कि एक ऐसा मिनिमम आपको रिटर्न चाहिए, मिनिमम आपको रिटर्न अर्न करना है कि ताकि जो कंपनी के शेयर प्राइस है मार्केट में जो ट्रेड हो रहा है, जिसका सेलिंग एंड परचेजिंग हो रहा है, उसकी प्राइस अनचेंज रहे. If you are not getting that minimum return, it may happen that your price of shares in the market will falls down, and that time may come when you need to close your business. Okay, here unchanged matlab ki we are not trying to increase or up the share price price of the equity share in a market, but we are trying to maintain the same level. We are not putting efforts to increase, but we are putting efforts to stay at that particular level. We don't want to decrease the share price of the market. Share price of equity share in the market. Are we clear about this one? Okay. Now the important part for all of you. Very, very important. Please be here. For calculating the cost of capital, we have these methods. Probably 5 methods are there. Okay. And we will learn practical question of each and every method. The first one is dividend price approach. Dividend price approach. Some authors have called a dividend approach, a dividend technique, dividend method. Second one is dividend price plus growth approach. Third is earning price approach. Generally, it's known as EPS, earning per share. Number 4, bond yield plus risk premium approach. Bond yield plus risk premium approach. And number 5 and last important, CAPM. Okay. CAPM stand for Capital Assets Pricing Model. Please remember this short form. Very, very important for mid examination or for final examination. Full form may ask in a MCQ or 1 mark question. You may first take a screenshot. Everyone, take a screenshot, and then after we will go for the first approach. Are you ready for the first practical question, first method? Everyone? Are you ready? Yes, Jenny is ready. What about others? Okay, believe me, this is easier than the time value of money. Time value of money is easy. This one is easier than this one. That one, sorry. So now let's begin with the number 1, dividend price approach. Dividend price approach. Please note down the first method in your book, dividend price approach. Okay. Okay. Now back to the example of X, Y, and Z banks. Okay. You have invested a 5 lakh rupees or deposited 5 lakh rupees in a bank, respective banks. Okay. Well, generally you are preferring the Y bank. So you have invested 5 lakh rupees in a Y bank, and bank will provide you a 50% interest. Are you getting my point? So this 15% will be your income, and for bank it is an expense. The concept is clear. बैंक के लिए वो expense है, आपके लिए income है कितना है 50% है. Okay, similar concept is applicable here. Suppose ABC company is there, okay, and ABC company has issued the equity shares in the market, and you have purchased the equity shares of the company. Suppose you have 10 shares of ABC company, each of rupee having 100 value. So 100 into 10, you have 1,000 shares, each shares, okay. Now ABC is earning a good amount of profit, and they have decided that we will distribute 10%, sorry, let's take 5%. 5% dividend to equity shareholders. 5% dividend to equity shareholders. So here 5% will be considered as cost of capital. Are you getting my point? This 5% will consider as a dividend, and this 5% is considered as a cost of capital. Okay. I know that. Let me check if we have. Okay. First of all, write down the formula. KE. KE is equal to D. D means dividend per equity share. Dennis and all others, I will explain later on. First, focus on our formulas. Okay, I will explain that concept with the practical numbers. So it will be easy to understand. KE is equal to D divided by NP. NP means net proceed of an equity share. How to calculate net profit, that I will again explain to you. or else KE is equal to D divided by PO. Sorry, it's P0. It's not O, P0. P0 means a current market price. Formulas are done. Very simple. K is equal to D divided by NP. Okay, or Ke is equal to D divided by P0. Hello. Yes. Just 1 minute. Okay. Now, now we try to understand the concept, formula, and calculation of cost of capital with this example. A company issues 10,000 equity shares, each of rupees 100, at a premium of 10%. Company has been paying 25% dividend to equity shareholders for the past 5 years and expected to maintain same in the future also. Compute or calculate the cost of equity capital. Okay, three parameters are here. Number one, 10,000 equity shares are there, each of rupees 100 and issuing at a 10% premium. Issued at 10% premium. Number one. Parameter number two, the dividend rate is here 25% from last 5 years and it remains same for next future also. And three, calculate the cost of capital. The question is clear? Question is clear? Okay, just 1 minute. As I explained that for each and every practical aspect, we will use Google Sheet. So let me share the Google Sheet and then after we go for the further discussion about a practical question. See, this is visible to you, all of you. Now here our first practical question. Yes. Now tell me one by one. Whatever the details are there, first we write the details. Okay. How many number of shares are there? How many shares are there? Number of shares? Okay. 10,000 shares. Okay. Face value और इश्यू वैल्यू, इसको हम फेस वैल्यू भी बोलते हैं. सॉरी, यस, फेस वैल्यू each of rupees how many? Face value is 100. Okay, so rupees 100. Now moving ahead. Now issue value is equal to issue value is equal to how many? Face value is 100, each of rupees 100. I agree. But company has issued this equity shares at a premium of 10%. At a premium of 10%. So whenever we have any premium, that means here face value plus premium. If we have discount, we need to deduct it. Okay, face value plus premium, and here face value is 100 and premium is 10% of 100. So your issue price will be 110. Are we clear about the calculation? Maybe in the next practical question, we have a discount, 10% discounts. Okay. So here issue price is equal to face value minus discount, 100 minus 10 is equal to 90. If we have discount, we need to deduct. If we have nothing, okay, each of rupees 100, full stop. Then issue price and face price both are same. There is no variation. If we have premium, we need to add. If we have discount, we need to deduct. Are we clear about this concept? Okay. Now, dividend rate, how many percentage that generally company is paying? That is 25%. Okay, this information is available with us. Are we clear about this four? Okay. Now, put the formula here. Write down the formula. Your cost of capital. We need to find a cost of equity capital. Okay. So whenever your K stand for cost of capital. Okay. E means cost of equity capital. Sorry, cost of equity capital is equal to D divided by NP. Okay. D divided by NP. Here D stand for dividend rate. D stand for dividend rate. Your dividend rate is 25%. Okay, 25%. Divided by NP. NP means net profit. So please remember your issue price plus if we have any issue expenses. Let me write here. Okay. Just 1 minute. NP net costing is equal to issue price plus issue expenses if we have any. In this case, issue price is 110. And is there any information about the issue expenses? No. So we assume it is 0. So it is 110. Can you tell me the final answer? Can you tell me the final answer? Sorry. 1 minute. It's a 25. It's not 0.25. It's 25. How many? 0. Your answer must be 0.2272. Right? 0.2272. So I'll be clear about, okay, Neville, please wait for this one. I will come to you. So the answer is clear up to this. Write down the amount of dividend, okay, and divided by NP. Here, actually, whenever we find a cost of capital, we always find a cost of capital in terms of percentage. For calculating that amount in terms of percentage, we need to multiply this formula with the 100. We need to multiply this formula with 100 like this. 100, okay. And here we have 50%. So ultimately, how we write? 0.25 into 100 divided by 110 into 100. Are we like write like this? I'm right? Because if we convert a percentage in a figure, then it must be 0.25 divided by 100. Into 100 is already there, divided by 100 and is there. So ultimately, in upper side, in lower side, we have 100 and 100. So no need to write into 100 and no need to write a 0.25. Are we clear? ओके अगर देसी भाषा में कहूँ तो वो दोनों का छेद उड़ जाएगा. ऊपर भी 100 है, नीचे भी 100 है, तो 100 उड़ जाएंगे. Okay, this is enough for today. In the next class, we will go for the next method. But before that, as I have discussed that today we have a